Have you ever got a set of financial statements at the end of the year from your accountant that show that you've made a profit of 100 grand, but your bank account's only got 10 grand left in it? Well, you're not alone, and a lot of business owners are left scratching their heads at the end of the year, wondering where all the cash has gone. Now, the confusion comes in here because at the end of the day, profit and cash are actually completely different things. G'day guys, it's Matt here from Day One Advisory, an accounting and business advisory practice helping businesses grow through exceptional support and practical, timely advice. In this video today, we're talking about the difference between profit and cash, so you guys have got a better understanding of what's going on in the finances of your business. As a starting point, let's talk about cash flow. Cash flow is just the cash in and cash out of your business over a period of time. So cash ins might be sales to customers, it could be sales of assets, or it could be you putting money into the business personally. Cash out are payments to employees, payments to suppliers, other costs, as well as things like loan repayments or drawings by you from the business. For a period, you have the opening cash balance, the cash movement being the ins and outs, and the sum of those is the closing cash balance. So if you were to look at your bank account for a period, you'll see an opening balance in your bank account, you'll see all the cash coming in and going out, and then you'll see the closing balance. Now, secondly, let's talk about profit and loss. A profit and loss statement is made up of the income minus the expenses of the business. Now, in that situation, if your income is above your expenses, you'll have a profit. If your expenses are above your income, you'll have a loss. Now, you might think that your cash for the period is equal to your income minus your expenses, but there's two key differences between cash flow and profit. The first is that there's some items that are cash inflows or outflows that aren't income or expenses. So for example, let's say you have a loan from the bank and you're repaying that every month. The cash going out of your account every month is a cash outflow, but the principal payment of that is not an expense for accounting purposes. So you've got a cash outflow, but you don't have any expense reducing your profit. In that scenario, your cash flow would be less than your profit. The same applies to payments to yourself. Maybe you're repaying some money that you lent to the business on startup, or maybe you're paying yourself a dividend out of the business. Either way, those things are cash outflows, but again, not recognized as an expense on the profit and loss statement. Now, there's a very long list of things that will be the difference between cash and profit and loss, but basically you just need to understand that there are some items of cash flow which aren't income or expenses, and so they don't go on your profit and loss statement. The second reason you're going to have a difference between cash and profit is that your profit and loss statement is generally prepared on what is called an accruals basis, which means your income is recognized when it is earned and your expenses are recognized when they're incurred. So as an example, let's say you do a job for a customer in June and you invoice them on the 30th of June. Say your terms for that invoice are 14 days and your customer pays on the due date being the 14th of July. In that situation, you've earned the income by the time you've issued the invoice. So on your profit and loss, you would record the income on the 30th of June, but you wouldn't actually have that cash inflow until the 14th of July. So if you ran a report at 30 June, it would say that you have a profit, which includes that income for the invoice, but that invoice hasn't actually been paid until the next period. The same applies for expenses. Let's say a customer sends you an invoice for an expense, but they give you terms of 30 days. So you take the full terms and pay them at the end of 30 days. Again, in that situation, when you receive the invoice, it would be recognized as an expense, but you wouldn't have the cash outflow until 30 days later when you actually pay your supplier. As you can see, there's some differences in timing, which means that your income and expenses for a period aren't going to match up with the cash inflows and outflows. It's perfectly normal to have a difference between your profit and your cash for the period. In fact, not a single one of my clients would have a profit and loss at the end of the period that is equal to their cash. So in this situation, the issue is not trying to match those two things up and make sure your cash equals your profit, but is understanding that they're different and then running the right reports so that you understand where all of your cash is going and why there's a difference. A cash flow statement is the most important report you can run as a small business owner. A cash flow report shows all of the cash, not just from the income and the expenses, but it also shows all other cash movements such as asset purchases, loan repayments, or maybe your drawings from the business. You should be running a cash flow statement report on a regular basis to understand where your money's going. And then once you've got a handle on it, reintroduce profit and loss and balance sheet and use those 3 reports collectively to get a good understanding of what's going on in your business. To sum up what we just spoke about, cash does not equal profit. So it's okay for there to be a difference between those 2 numbers, so long as you understand how you're spending your money and where that profit is going.
Audio Jungle.